Welcome to the Escape and Empower podcast. Escape from the corporate rat race to empowered franchise ownership. Are you ready to take control of your destiny, follow your dreams, and live life on your own terms? Join our hosts, Dave and Pete, for insights on how to break free from the corporate grind, ditch the 9-to-5, and step into empowered franchise ownership.
Welcome to the Escape and Empower podcast. My name is Pete Gilfillan. I'm here with my podcast partner, Dave Greenberg. Good morning, Dave.
Good morning, Pete. How are you on this wonderful morning?
Oh, I'm pumped up. I'm super excited.
Good. We caught a good football game last night. I won't even talk about the winners and losers, but it set me up for a great day to talk about what you need to do to win in the marketplace and franchising.
Well, absolutely, right? And my wife went away for the week, and so my son and I are home, and so it's a boys' week. Right. And so we're eating bad, we're watching football, all that kind of stuff, hanging with the dog. And he was talking to me, he said, Dad, I want to someday have my own business. And so we were talking a little bit about that. And he goes, well, how much money do I need? If I'm going to do my own startup, maybe I won't do a franchise. Maybe I'll do my own kind of tech startup. But what do I need? And so I thought what we do today is, because you get the question, I know I get the question all the time, is how much money do I need to invest in a franchise business? So I thought we'd solve or answer that big question today. Sound like a plan?
I think it's awesome because it's a great discussion that I always have, either on my initial calls or when we get deep into the consultation.
Yeah, I mean, you need to know that up front because you don't want to invest a bunch of time. And if you can't afford to invest in a franchise, then it just doesn't make any sense. Or you have enough capital, but it might be stretching it too far. So when we talk about investing in a franchise, there are kind of two numbers you need to know. So the first number is liquid capital. So when we look to invest in a franchise, you need a certain amount of liquid capital. Now, fortunately, as you know, liquid capital is loosely defined. It can be cash, stocks, bonds. It could be equity that you have on your home. You tap your home equity line. It could be retirement dollars instead of investing in stocks and bonds, investing in your business. It could be your stock portfolio. You take a line against it, invest in your business. It's anything but like an SBA, Small Business Administration loan, right? So liquid capital is the first thing. And I think about like when I invested in my business, I use some of my retirement dollars as my liquid capital. Did you do the same thing when you were starting your business?
I did, Pete. I rolled my 401k into the ROPS program to get it all going.
So there's liquid capital. And when we talk about liquid capital, there's a range, and we'll kind of get into that. But from a standpoint is the second number is the total investment. You need to know how much the total investment is of the franchise you're considering. And total investment is everything it would take to get that business up and running, from paying the franchise fee to attending training to building out the facility or leasing equipment and working capital, cash to carry the business to break even, right? And I know you put together pro formas and stuff like that. At least I did when I was looking at investing in my first business. I put together a pro forma to take a look at how much capital I needed. Certainly you look at the item 7, the investment range, but you kind of put together what's it going to cost to get into this business. And there's certainly a range from that standpoint. Did you do that same thing when you were looking at investing in a
I did, Pete. And I had this conversation just yesterday again with a great candidate. And he was really trying to put his head around his total investment. And I took him through the scenario that we worked with when we looked at ours. Franchise fees for the total investment are going to vary. Are you going to look at a single location or a single territory or multiple locations or multiple territories? And that is the upfront fees, maybe some training on top of that, but you'll have to be prepared on that total investment to understand what your upfront costs are going to be, because at the end of the process, you're going to have to wire those funds to get into the game and become a franchisee if you're awarded that opportunity. The second thing I was talking about with this candidate yesterday was working capital. And he says, how do I get my head around that? Well, it's real simple. You're going to build your pro forma, but then you have to decide how many months of fixed expenses do you want to plan for? Do you want to carry? So you're not having to go back to the bank for more money if it's not working exactly the way you planned it, or to make sure you have enough to double down on investment if things are going really well and growth is staring you in the face.
Yeah, absolutely. I think, when we talk about working capital, that's something you want to have extra, right? When you don't need capital is when you get it. When you need capital, you can't get it. So you always want to make sure you're capitalized well, because if you run out of cash, you run out of capital, you're cooked, right? So, and I think I want to go back to that total investment, because, you're right. You got to look at what the check you have to write when you launch the business. But like, if I'm going to open up 3 locations and each location is going to be over time $750,000 each, I don't have to have over $2 million available at that point, right? I just have to have the means to be able to, over time, open those. But I don't have to have all 2.5 million or whatever the number is up front when I sign. I have to pay the franchise fee for the territories or the locations, and then I got to focus on that first location or that first territory, capitalizing it correctly, or paying the total investment, right?
So, and that's a great point, because often, and was the case with our franchise agreement, our addendum was an area development agreement, and that outlined what time frame we were going to commit to opening the second and third location. It's usually in months. And that way you have an agreement between you and the franchisor to support what you just said. I don't need to capitalize for building out all 3 at one time. You build them out over time. And the ideal scenario is if you can cash flow the second and the third and the fourth and the fifth out of the first, second, and third, you can really think about, all right, how much additional capital do I need? Can it come from the first location? Do I need to take distributions and want to put more equity injection? What kind of capital loan am I going to take for the second and the third? So it's just planning, and it's kind of like a rinse and repeat. But to your point, it's planning, and you don't have to think about all 3 at once. You think about it over time, but you need to get started somehow. And the total investment is how many locations, how many territories are you going to take down, and what does it take to start up in the beginning?
Yeah, first location. Yeah, absolutely. Let's put a little bit of context in this. All right. So as we talk about franchising, there are 2 basic business models. There are service-based franchises that go to people's homes or businesses and provide product or service. So they come to my home and wash my windows, they come to my business, wash windows. So there are service-based businesses, and then there are facility-based franchises. So think of that strip mall down the street. Somebody takes 2,000 square feet and they create a place where you can get a haircut, get a sub sandwich, get a massage, take a Pilates class, right? Facility-based. So when we specifically talk about service-based businesses, the numbers are a little bit lower. So when we specifically talk about a service-based business, you need a minimum of $75,000 liquid capital, right? To get in the game, can't be borrowed, can't be an SBA loan. You need to play $75,000 liquid capital.
Absolutely. The way you characterized it, they're super capital efficient investments when you think of alternatives to service-based businesses that are a higher level investment. It's a great place to put money. And it's the same as taking down a number of locations. You take down a number of territories. The territories typically say 200,000 households, get 3 to 5 territories, and you can take 600,000 to a million households as your area and really plan for growth. So service-based business, as you say, really can be capital efficient and really reduce the minimum requirements on a startup from a liquid capital standpoint, but it also has a great opportunity for growth.
Well, yeah, and I think as you take a look at service-based businesses, they are efficient because they are a lower investment, and it's a more reasonable or lower investment to scale it, right? It's easier to scale, faster and higher. So the other number is the total investment. So when we talk about service-based businesses, the total investment will be something greater than 100,000. Right? So it could be 135,000, it could be 210,000. It'll be something greater than $100,000. And again, it depends on what you were just saying, the number of territories, the type of equipment, anything else you can think about. So there's a range there, but you can expect for a service-based business, the total investment will be something great over 100,000.
I think of a friend of mine who owns a mosquito and tick control business in Maryland, and he grew it over time to have, last time I talked a couple of years ago, 1,800 accounts. Servicing 1,800 accounts, I'm guessing you're trying to remember, maybe 11 technicians and 10 trucks. Now, did he get there in day one? Absolutely not. Did he start with a technician and a truck and then add to it as his revenue base grew? Absolutely Absolutely. So over time, your total investment's going to grow. But the key thing there is, as revenue comes along, you have the ability to invest in trucks and techs and trucks and techs. So it's nice to invest along with revenue that you see coming in, but you have to have that working capital sometimes to make sure you can lease, finance, or acquire that additional truck and hire that tech. But it's real planning that goes into that growth of that service-based business.
And certainly when he put together his pro forma and he's planning the business, he had the working capital plan to be able to do that growth. But I think if you look at that simple business that he did, that was not a large investment starting out, right? From the standpoint of setting up. Now, if he decided, up front to do 5 territories, that's different. But setting up, getting that first territory going, that wasn't a large investment in terms of liquid capital or total investment, right? It was a very efficient way to do it.
I love the back of the napkin work that goes into the pro formas that you develop. That's really not, it's in a spreadsheet, but you start thinking of these service-based businesses and, what's the average job, not only in dollar value, but time? And then how many jobs can you do a day and how many jobs can you do a week? There's 260 work days in a year. The formula becomes pretty straightforward about how much a tech and a truck is going to cost from a total investment standpoint. But then you look at utilization of that asset that you've just invested in and start figuring, okay, at 70 or 80% utilization, what can you get out of that truck? Is it $200,000, $300,000, $400,000? And then you start thinking, okay, if I want a $2 million business and I can get $400,000 out of a truck. Okay, so I guess I need 5 trucks running around to do that. It's really interesting how you take the conversation of a service-based business that we've had around the liquid capital requirements and total investment, and then start building out your performer, which the candidates do in the process.
Yeah, and I just talked to a guy that I placed in a franchise concept, and he was ordering another van. And what he said was he basically read this book and listened to a podcast or listened to the author speak. 10x is better or easier than 2x, right? And they kind of talk about that you get your resources or you get that next van or that next truck or that next crew in advance of when you need it. So he said, he was pretty excited. He goes, I got this van and it was absolutely the right thing to do. My business is growing. And so it is a fine point, but you want to do it earlier opposed to later because you don't want to get behind. You want to try to get to that utilization rate that is the break point, and then you get to the next one fast.
Right. And then there's the other piece of investment that we don't want to miss. And we've talked about this, Pete, in other podcasts. Are you going to take an owner-operator approach? Or are you going to take an executive model approach? What's your approach going to be to leading the business? And my point is when you're thinking about total investments and you decide to say, I want to work on the business, not in it. I want to hire a general manager to handle the day-to-day activities, maybe while I keep my job or maybe while I focus on other things, but that takes capital. And so you're going to have to think about that 50, 60, 70,000, whatever it is, general manager that you have to capitalize for in the total investment when you're looking at your ramp to grow the business and start the business. That makes sense?
Yeah, you're spot on. I agree 100%. You have to capitalize for that manager. But I look at it as a very simple trade-off, right? If I can be in a corporate job making $300,000 a year, and I can pay somebody to be watching over my business $50,000, $60,000, $70,000, right? I've got to watch over them. I have to lead them. But that's a great trade-off for me, right?
Sure.
All day long. But to your point, you have to be capitalized. All right, so we talked about service-based business. Let's move to facility-based concepts. So again, you have that strip mall, you take 2,000 square feet and you create your business, right? So you got to build out that space. So now our numbers jump up, right? And you're an expert in this area, right? So from liquid capital, you need a minimum of $100,000. That at a minimum, you need $100,000 liquid capital. And the total investment for a facility-based franchise concept could be something greater than $200,000, right? It's going to be $250,000. It could be $450,000. It could be $650,000. It really depends on the build out, the size, all that kind of stuff, right? So now the cool thing is that a lot of times with facility-based franchise concepts, if the total investment is $200,000, liquid capital requirement's $100,000, you could go do like an SBA loan. You can leverage a little bit, especially when we talk about facility-based franchise.
Yeah, and I love this discussion, as you mentioned, because I lived it and breathed it. And there's so many things behind the total investment that we'll get into, but liquidity is super important. In our future podcast, we're going to bring on one of our financing partners and talk about liquidity requirements as you think about a funding strategy. But it's really, to put it in simple math, maybe napkin math, you say, okay, if I'm going to do a $600,000 total investment, you're going to need at least 30%. Maybe you can get away with 20%. So, it's real simple. It's $180,000, at looking at a total investment of $600,000. So you start to see, versus the conversation we just had, how that liquid capital requirement jumps up in a facility-based business.
Right. And you could, for example, as we talked about liquid capital being loosely defined, you could use your retirement dollars through the ROPS program, tax compliant, right? You could basically, for that $180,000 or that 20%, bottom line is you could use your retirement dollars through ROPS, and then you could do the SBA for the other 80%, right? So the idea is that you kind of leverage your capital in multiple different ways. And again, we'll do another podcast that we'll talk about all the different ways you can fund a business or combination of ways.
Right.
So now when we talk about the franchise, right, in addition to having liquid capital and the total investment, there's one other variable we got to look at is total personal net worth. Right? Because you got to have a certain amount of net worth to qualify to become a franchisee. So franchisors have really 2 or 3 financial criteria. They'll say, one, to be eligible to invest in a franchise, one, you have to have so much liquid capital. We've talked about that a lot today. Number 2 is that you have to have so much net worth, because if you're leasing a facility, leasing equipment, a landlord or a leasing company is going to want to know you have means. And then you also have to have a certain level of credit. For some franchise companies, we're over whatever the number is, 800 or the number. So you have to have the means in terms of overall net worth.
Right, absolutely. Because the balance sheet is super important. Now, if you're not carrying the balance sheet and you really want to do something big, there's nothing wrong with a partnership, whether it's an active partnership or a silent partnership. But that partner needs to become involved in the process and work through to become part of the franchise agreement and your plan. So, you can look at your personal net worth, and yes, maybe it's not the right time. I have a lot of folks that I talk to, and they think of their net worth and they think of what they're going to put into the business, and they're feeling like it's going to leave them a little skinny on their family requirements or their safety net. It's just not the right time.
Yeah, and I had that conversation too. I just was speaking to a gentleman the other day, and we were talking, and it had a net worth of $150,000. I said, listen, if you were to invest in a service-based business, you're going to take at least 50% of your overall worth and you're going to put it into a business, at least. And that may be too much, right? And so we don't ever want to stretch. So we take a little bit more time to build up our cash reserves, but we don't want it to stretch too much. And so that's a really important point you made.
And, when you think of the minimum net worth requirements, we have everything from, let's call it 100,000 all in to many $1 million of all in. We have, 200 plus franchisors in our portfolio that we work with all the time to create a right fit with our candidate. But, because it's $100,000 all in, doesn't mean it's any less of an opportunity than the multi-million-dollar all-in. What it means is it probably fits what you're looking for. And some of those examples, we were talking about this before the podcast, were in some of the consulting opportunities that we have.
Yeah, absolutely. I mean, there's all types of businesses for all types of financial levels, and it's about finding the right fit for you.
Right.
So at the end of the day, when we talk about, hey, how much money do I need to invest in a franchise? It's a little bit more than, hey, this is how much you need. There's multiple variables, liquid capital, total investment, net worth, but it all ties together to make sure that you have the capital necessary to be successful as a franchisee. Because again, if you don't have the capital, you go into it light, it can be a very difficult proposition. And bottom line is that we have to make sure we're setting ourselves up for success.
People talk about risk. How much risk is there? I said, well, this is kind of a time when you look in the mirror. Risk is really created about how hard are you going to work? And one of the questions, and there are many other things behind that, one of the real things is, okay, are you going to be able to capitalize properly? Because if you can't, you're just increasing your risk, and you should think twice.
And I'll just touch on, because you mentioned partnerships as a way to capitalize a business, and I've got a little biased against that. I think partnerships sound really sexy, right? I'm going to partner with somebody, they're going to put in half the capital, maybe I'll offload half the risk. But the problem is that partnerships don't always work out, right? And it can be very painful, almost get divorced. So if you do a partnership, you have a very ironclad partnership agreement that clearly defines everybody's roles, and more importantly, an exit strategy. So if this thing doesn't work out, we all clearly know what happens to dissolve it. And people kind of rush into partnerships, and I always tell them, just take your time. If that's something you really want to do, you have to think about it, because it's another potential stress.
I agree 100%, Pete, with that statement.
Excellent. All right. So I think we answered the question today, and have an awesome day.
Thanks, Pete. Really appreciate the conversation. Talk to you soon.
Thanks for tuning in to the Escape and Empower podcast. We hope today's discussion has inspired you to consider franchise ownership as a path to living life on your own terms. Start your journey towards financial freedom and flexibility. Connect with Dave at empoweredfranchisee.com or Pete at hireyourself.com. Until next time.